Okay, welcome. My name is Brian Alexander, MoneyWise from MoneyWise with Brian, and affiliated with Lawson's. So today I got Greg with me. Greg's going to speak to us a little bit about UK property. So going to be an interesting subject, and a little bit about why property and part of your portfolio. I really believe that we need to be looking at diversifying your portfolio, and I think that's crucial. Whether it be whatever asset class that you're looking at, it's to diversify. I think that's really key, and I don't think I want to say too much around it, but I think the key to any diversification is a personal scenario. So it's not one thing fits all. It's really about how is your portfolio going to look like? What's best going to fit into your portfolio? What sort of risk that are you prepared to take, and what sort of term do you have that's available to you? So there's many things and facets that go around it, but that comes in a very much more personal discussion. But Greg, thanks very much for joining us, and trust that we'll add some great value here. I'm sure you're going to. So far I've heard good things, so I'm really looking forward to it. So over to you. Just give maybe a little bit of an introduction of who you are and what you're doing, and what line you are. Over to you, Greg.
Perfect. Yeah, well, thanks obviously for the invite, especially as we're running up to Christmas as well. I think it's a perfect time of year to have this conversation, as people do think about, how their year of investments has been. Have they made the right decisions and choices through the year, and how they're ultimately going to go into 2024. From my side, as you've introduced, my name's Greg Stockton. I head up global sales and distribution for Global Residential. So for those of you that haven't heard of the business, we're an investor-led property investment firm. So ultimately, we help firms like Lawson's and different IFA groups and property companies around the world provide good quality investment stock for their clients. That sort of journey ticks many boxes, starting at point A, which is sourcing good quality property. So we have a team in the UK that go and meet the developers, see the sites, do a lot of the heavy lifting and the due diligence before it hits my desk and ultimately yours. And we also have an in-house legal firm to help clients make sure they can get through that legal process and get exchanges done quickly. And we have an in-house mortgage broker team. So for most of our clients that are looking to get lending as part of that property purchase journey, we can help with that. And then we have our own in-house lettings and management firm as well. So when you reach the end of that journey and you've taken ownership of your units, you obviously need to go and find a tenant and have that part of the property managed. We have our in-house lettings and management company that do that. So really a full turnkey solution, which makes it very easy for clients. My background has traditionally been financial planning for about 20 years. So I've run a number of different IFA firms, as well as being a financial advisor myself. And pretty much the last 7 years been involved in the property space. So yeah, obviously I look forward to discussing that a little bit more detail with you today, and obviously supporting Lawson's and yourself where we can.
Oh, great. Well, just around that then, why have you found that investors consider property then for part of their portfolio, and why so in the UK? How have you found it?
I think, look, investors, as you pointed out when we started the Zoom, ultimately they want diversification in a portfolio, and as a financial planner, obviously it's your job to provide that diversification in any way possible. I certainly found in sort of the back end of my career on the IFA side of the business, people do tend to be quite stock heavy, which, for sort of 10, 12 years, the markets were doing incredibly well. And I think now people are a little bit more cautious, so that they try and tend to flock to things that do look a bit more stable and a bit more secure. And there's probably no better asset class than UK investment property for giving that consistency, certainty and comfort. And just I guess a couple of one-liners or stats from the UK. I mean, first of all, you've got a huge undersupply of property versus demand. So the UK government initiative right now needs to build roughly 300,000 homes a year just to keep up with the demand. So whenever you've got that shortfall and that gap, generally it's really good from an investment standpoint. But when you look back over, the last 25, 50 years, that's really when you see the true value of property. So, you're averaging out at the moment 5.5%, 6% year on year capital growth. And that's not including, rental yields. You've got 19 out of the last 25 years properties beat inflation, which obviously there's a lot of inflationary concerns in the UK at the moment. But probably the biggest stat over the last 50 years is that UK investment properties had 43 positive growth years out of the last 50. Now, I don't care if you're selling UK property, a stock, a fund, if you can demonstrate to a client that it's had 43 positive years out of 50 with low volatility, most of those clients will breathe a sigh of relief and say, okay, that's something that I want to explore further. So for me, there's no better market from a property standpoint to give that consistency, certainty and comfort than the UK.
I think, well, that takes away a lot of, I would presume, a lot of risk, because if you've got 86% over a long period of time, I'm not talking about percentage, but an 86% positive return out of 100, that's not bad. I just want to ask you a question on that. So in other words, you're indicating when the risk is there, it seems asset-backed is more favored than a non-asset-backed investments.
You mean in terms of what, property versus something else, or you mean as in just property specifically?
Well, as compared from, if you had to compare property to, say, if you're going to buy stocks in equity, that does not have that asset backing to it.
Yeah, but I think it can depend really on, I guess, where you're at in your financial journey, right, and what you're trying to achieve. And as you know, as a financial planner, everyone's goals are very, they're very different, depending on whether they're, a 30-year-old versus a 50 or a 60. And I think obviously what you'll get with stocks and shares is when the markets are flying, you'll obviously get periods of years where you are making 15, 20, 30, 40% returns, which is fantastic. And you're never going to get that through UK property. But what you are going to get is that, as I said, it's that consistency. You're going to have a tenant in your property, so you've always got that comfort that even if the markets are down a little bit, you've always got that rental return. And I guess probably just to put that as an example, like a concrete example, if you think about your retirement, imagine you're going into 65, and we've got two 65-year-olds next to each other. One's got £1 million stock portfolio, one's got £1 million property portfolio. They're taking 50 grand a year out of the stock portfolio, 5%, and they're getting £50,000 worth of rental yield from that £1 million property portfolio. Well, if you get another COVID or a 2008, and all of a sudden the financial markets drop 30%, that million that you have there goes down to 700. That 5% now means you can only take out 35 grand a year versus 50 what you were getting. So that impact of having just a stock portfolio has massively affected your retirement ability. Whereas with property, even if you got a 10% drop in the property pricing, you've still got £50,000 a year coming in from rentals, because they don't drop, right? If anything, UK rental prices are going up every year. So it's a good way to secure income when you have that asset backed, something like a physical property.
Yes, I think something that you really said was really, really important, and that I found with anyone that's I'm advising around pensions, and it's just a point that you brought up. And when the market is a little bit more on the tougher side and it's not producing like it should, one of the key things is that I've found is that people don't go back on their expenses and their income, just not able to go back on their budget. They've got to keep at their budget. So what happens is they still take the same income, but now they start eating into their capital. So although their capital might have decreased by the market, it's now eaten by a second factor, the fact that you still need the same income. So the percentage you might have been taking might have been 5 or 6% out of your pension. Suddenly it rises to 8%. And that starts to eat off your capital, especially if your return has dropped down to 4% and you're now taking 8%. So you're losing 4% per annum on your actual capital. And that has happened to many. I've seen many a client that have made the wrong decisions and and have been adamant about it and have eaten into their capital 10 years down, there's no more pension left. So it's crucial.
Exactly. And you wouldn't want to be in that position, surely, right? Get to 75 and all of a sudden, still be like, relatively young in the mind and lively, and then have no money left from your pension. So, look, I think again, it just speaks for the diversification story. The good thing about having part stock portfolio is you do have that liquidity there if unforeseen things come up, or you want to take an extra holiday, or you want to do something, right? It's difficult if it was 100% property portfolio, because you couldn't necessarily just take a few bricks off your roof and go and sell them to create some liquidity, right? So I think having a balance of the two is key. And also, it doesn't necessarily have to just translate to retirement planning. I think there's a lot of young families out there, especially in the expat world, where at some stage their children will probably go back to the UK for university. And the two biggest expenses that you have to plan for, and I've got an 11-year-old, which I'm currently trying to plan for myself, are going to be the school fees as an overseas student and rent. Because I don't want my daughter living in a accommodation where it's either unsafe or in an area which is not necessarily desirable. So it's actually a good idea to maybe start thinking about, okay, do I get on the property ladder now? So that when my child gets to university age, I might be really lucky and she goes to a university in an area where I happen to have brought. So Manchester would probably be my, throw at the dartboard of where I would hope. But if she went to somewhere else, then I've either got a property at that stage that, I can use that rental income to pay her rental wherever she's going to live, or I can potentially sell that and buy her something else. So it's actually a really good way to think about children's education planning as well.
Okay, that's another very good thought to consider. So tell me, a majority of your clients, they are based where, and why do they choose UK property?
It's a really broad mix, to be fair. I wouldn't say there's necessarily one specific location where our clients kind of congregate. We do a lot of business in the Middle East. We do a lot of business in Africa and Asia, Eastern Europe, Western Europe, and we do quite a lot out of the UK as well. So it is very evenly spread. I mean, just to put some numbers on that, I think in total, last count, we've helped something like 84 nationalities so far purchase UK real estate. And the reasons are kind of what I linked to before. It's that consistency, certainty, and comfort. But there are certain pockets of the globe where the reasons are probably more amplified. So Africa's a great example, right? Most people there are looking to potentially hedge against the local currency. Before we started this Zoom, we had a conversation about South Africa, right? And what's happened to the rand.
Absolutely.
And if you look at the rand versus dollar, euro, sterling, and then versus that to UK property over the last decade, UK property has gone up about 65% over 10 years as an average, and UK sterling to rand has gone down about 40%. So you kind of lost on both ways if you haven't exited capital. So, those problems on currencies translates to Zimbabwe, Nigeria, pretty much pick any African country, and there's probably a need for them to hedge that currency. We've already mentioned, the amount of people that are probably sending children to UK universities. There's more children in Africa now going to UK uni than ever before. Obviously, that's the stability factor and just diversifying portfolios. So those tend to be the main reasons.
So if you had to say, what are the benefits, what are the real benefits, or what are the major benefits of considering property as one's portfolio? What would you say? We might have answered a little bit of that already, but what would you say is the major benefits of considering property? And if so, in the UK as well?
I always go back to those 3 C's, right? It's that consistency, certainty, and comfort. Right. I mean, you invest client money on a day-to-day basis, and I have no idea how much money you manage. And I imagine a percentage of that, or a large percentage, is in the stock markets through, mutual funds or direct stocks. That can be a very good investment, right? And it can be a very lucrative investment. But you do get clients to have some sleepless nights, especially when we get periods of downturn. So I think for me, the reason why somebody would invest into UK property, the main reason is that they do want part of their portfolio that does give them that consistency, that certainty, and that comfort. And as I said, there's no better asset class than UK real estate to do that. Now, of course, there's a lot of intricacies to buying UK real estate, which maybe we'll come on to, but those would be the reasons, and that would be my takeaway, that those three C's are the sort of main reasons.
Excellent. And the general market at the moment, how does it affect property otherwise to the other asset classes? How's it been affected over this last 2 or 3 years?
Look, the last 12 months has been somewhat tough in the UK from a property standpoint. I mean, I think it's been tough everywhere for one reason or another, and UK property has not been the only negative benefactor of market conditions and wars in the Ukraine and Russia and everything else that's going on. But obviously, we have had a big peak in interest rates, right, which of course has affected mortgages. So June and July this year was what I'd probably class as a train smash in the market. More so from a sales perspective, people did stop buying because lenders stopped lending. People started being more careful with what they were borrowing. Rates went astronomically high compared to where they had been recently. And then, of course, every UK tabloid, as every UK tabloid does, where it can find a negative story, it picks it up, injects it full of steroids and puts it out into the social media stratosphere. So, for a good number of months, it was all doom and gloom and property markets crashing and the world's going to end and don't buy real estate in the UK. The reality of it is, though, most of the stuff that was reported didn't happen. People have continued to buy. Lending has continued to move forward. Mortgage rates have now started to come down. So we're starting to see, certainly if you're based in the UK, mortgages with a 4 at the start of the rate as opposed to the end, which is good. And we'll slowly start to see those mortgage rates trickle into the expat market. So confidence is back. People are starting to buy, and what people predicted was a bit of a train smash in the property market hasn't happened. But I think what's really important to note, and I'll probably fire the question back to you actually on it. I know it's not a question that you'd need to prepare for, but if you're looking at the stock market and we talked about a train smash, what would a stock market train smash typically look like in terms of percentage points, do you think?
You say that again? What would
a train smash look like if we were relating that to the stock market? If we thought, okay, what's the doom and gloom scenario for the stock market? Percentage drop?
Probably in the region of between 10 to 20%, closer to 20, I would say. But it depends on, I suppose, from client to client. Some will take only 5% on a negative. Yeah. But a doom and gloom, generally, I would say it's between 10 and 20. And when it's getting over that, then it starts to become really, really serious.
Yeah, no, I agree with that. I mean, I think, if you look at like COVID in 2008, you had, stock markets dropping 20, 30, in some cases, certainly some funds and stuff, 40% down. They rebound pretty quickly. But what my point was, when you're getting at a train smash in the stock market, it can be very volatile. When you look back at a lot of the UK property reports and they talk about a train smash, you're looking at a 5, 6, 7, 8% down, downward spiral, which in the grand scheme of things isn't really in our world a huge train smash. So yeah, I think you are a lot more protected in the UK, but look, the rentals have been the biggest strong point for UK real estate in the last 12 months. So although there's been a lot of doom and gloom about, mortgages and prices potentially correcting, and in some locations in the UK, and I'm not suggesting they haven't, because they certainly have, but rental yields have continued to rise. So the average rental pricing is, in the last 12 months, has gone up by 14%. Manchester alone, as an example, has increased its rental value by 20% in the last 12 months. So, although some properties might have taken a slight knock on value, your rental pricing is so high, and it goes back to that conversation we had just now about that consistency of income and that certainty by having that physical backed asset. So yeah, it was a tough couple of months, but actually, since I'd say August going to September, it's been extremely strong.
Another question, and that is, when it comes to actual position and location, how crucial is your location? I've been in property for 14 years, so I probably know the answer, but I'm going to ask you anyhow. If you can, and whichever way you ask, if you can explain why. So whatever your answer is, why?
Yeah.
So if you can help our listeners out to that one, is choosing the correct location crucial?
Yeah, 100% it is. And it's the location can take many forms. We will typically look at location based. Okay, what's going on with that location? What are the current rental values? What's the market value? But actually, is there any regeneration going on in that area? Which is obviously extremely important. It's interesting when you speak to a lot of expatriate clients, especially in South Africa and Africa, and you talk about UK real estate, and we discuss location as part of that journey. And the answer we get back quite a lot is London. And you go, why London? And it's like often it's the only place that they, recognise or know or they've been to. The rest of the UK is just a bit of a in the bliss. So yeah, educating clients on why certain locations. I mean, there's obvious choices like Birmingham and Manchester, which have continued to boom over the last 10 years, and I'm a great believer that they will do moving forward as well. But it's then picking out the other pockets. So there are obviously lots of locations in the UK, but finding those areas where you've got a lot of regeneration going on, which ultimately generally dictates future price increases. We've got a project, for example, in Halifax at the moment. And some people go, well, why Halifax? Either A, I've never heard of it, or, why Halifax? What's going on there? And then when you look at the amount of money that's being pumped into the city or the town for regeneration of, city centre, roads, commercial, retail, real estate, you go, okay, I want to get in that before it's too late. Whereas you look at some other pockets of the UK, which on paper might seem cheap to invest into. I mean, I'm from a place called Stoke-on-Trent, if you know that. Terrible football team and home to Robbie Williams. You can buy some really cheap real estate there. You can get 6, 7, 8% rental yield, but there's nothing going on in that town and city from an investment perspective that would ever dictate any future house pricing growth. So yeah, it's about doing the research on those locations. And I think one bit of advice on that is that when you do an investment property, it's all about the numbers. It's do the numbers stack up now in a 5-year exit and on a 10-year exit. And if they do, obviously, that the location choices is our decision before we bring it to you guys. But, part of that DD on making sure those investment numbers work is that location, it is that regeneration story, and it is that future potential. So, and that's a long-winded answer to your question. But yeah, location is important, but it's important to look at what's going on in those locations.
So it's not only just, it might not only be, say, Birmingham or Manchester, but it's within Birmingham and Manchester, there are certain pockets as well that are having the right returns and the right uptake and etc. And it's not just the entire Birmingham, or is it so?
No, 100%. I mean, the Manchester example I can give you on that's probably the perfect example. I mean, Manchester itself has gone through, say, 10 years worth of growth. It's done about 70% worth of capital growth in 10 years. But over those 10 years, you've had 80% of the FTSE 100 companies move there. The economy's booming. 15% of people and companies that are leaving London are moving to Manchester. So it represents a great investment story. But there are pockets that have already been developed. So yeah, if you looked at that and you bought in there, you're kind of buying at today's value, but there's no real regeneration story around it. Whereas you look at the Victoria North, which is where the Manchester City Council have decided to expand over the next 10 to 15 years. So their plan is to build 7 different suburbs, house 45,000 new people, build 15,000 homes. You go, okay, from an investment standpoint, where I want to buy, because I'm part of a 10 or 15-year regeneration plan. And that's where, as an investor, you're really going to get the capital upside, which is what you want.
So, Greg, what I think I very clearly heard you say in a few last couple of things is 10, 15 years. So I assume this is not a 3-year journey. This is not a short-term investment. You're looking down the road for growth, returns, stability. So it's more of a long-term vision than a quick, let's see if I can time the market right.
Yeah, exactly. Look, it's the same with any investment, right? You know, you look at the stock market, you could buy a stock today and sell it in 6 months' time, make some great money, right? You can buy a rundown property in the UK, inject some capital, refurb it, flip it, and sell it on in 6 months' time, and there's money to be made in that. But from our side, being investor led, and it goes back to those three C's again, it's about providing consistency, certainty, and comfort. And that really only comes by looking to that mid to long term. So, yeah, typically most of our investors will exit property between sort of year 5 to year 10, or they'll refinance and buy something else. But yeah, this is definitely not a short term focused investment solution. It's definitely more mid to long term.
Okay, so you've painted a really good picture now. So why is it that not so many people are investing in this asset class as what they obviously should?
Yeah, look, I mean, that's probably the best, probably the best question you've asked today. I think because it is. I mean, more people, especially as I've mentioned in parts of Africa and stuff, which actually do want to. You know, I mean, we hold a seminar here for some of our partners, and we'll have 50 people turn up, and most of them go, "I've been looking at investing into UK real estate for 2, 3, 4, 5 years," and it's interesting when you talk to them, and go, "Well, why haven't you done anything about it?" I mean, number one, probably most of them have been waiting for the currency to get back to where it was 6 years ago, 7 years ago, which is it's never going to happen. It's a non-starter. But I think that the main answers are, okay, firstly is like, well, I wanted to buy in the UK, but I didn't know where to buy. Right. So I kind of know London, and that's pretty much it. So again, finding the location for these guys and girls and investors is key. And then, even if you find out where to buy, okay, well, where do I go to get legal help and support? I don't know anybody in the UK. I don't know what represents a good solicitor or a bad solicitor. If I found a good solicitor, can I get a bond? Can I get a mortgage? I've never lived in the UK. I don't work in the UK. I don't have a bank account there. It's probably impossible, isn't it? That's a lot of the feedback. And then even if I do those three things, well, how am I going to manage it? I never go to the UK. I'm not going to be able to meet the tenant, find the tenant. So all these, I guess, probably represent hurdles that in your mind you just go, oh, it's too complicated, it's too difficult, I'm not going to do it. And let's be honest, we live in a world where people want things now and they want it quickly, which is where investment platforms have done incredibly well over the last 5 or 10 years, right? You can log on an investment platform, fill your details and start investing. So I think that's the reason why is it's A, the education, then it's B, the resources to actually execute on a transaction. And that's where, again, when people actually find out that we help them with all of those stages and they understand that they can do it very much arm's length without having any stress, that's where then people start moving forward with transactions. So those are the reasons why more and more people don't do it. I think it's just understanding the difficulties, but how easy that process can be.
Okay, so you're saying really they can just pretty much sit back and enjoy the ride and know the money is, as you said earlier, it's a lot safer. It's an asset class that's a lot safer. So it's definitely something that they can tackle. So where you mentioned already the UK hotspots, Manchester, Birmingham, are there any others? And what would be the step one if they were to approach the UK property investing?
So we've tried to position our portfolio in a way that no matter what type of client we sit down with, within reason, there's always an offering that we can bring to the table. First thing from our side is obviously listening. It's understanding what the client's motivation for investing is, and then understanding, what capital adequacy they have. And again, a big misconception with overseas clients is they need to have £500,000, £1 million tucked away to even consider UK property, but that's not always the case. So first step is obviously understanding that client, the client position. And then based on that, looking at what stock's available. As I said, we're an investor-led business. So, our stock ranges from £120,000 as an entry level, which bear in mind people can lend on that as well. So you might only need £60,000 to complete that transaction. So 1.2 million rand if you're in South Africa, and right the way through to our new London stock in Canary Wharf, which studios start at 550 grand and go to 3 beds at 1.7 million, and everything in between. So we've got a project in Halifax, Manchester, London, and then new stock coming up in January. We've got something coming in Nottingham, York, and I believe Sheffield as well, and possibly Liverpool. So those will all be at different price ranges, and they'll all have different deposit structures. The lowest deposit is 5%, with the highest deposit being 20%. So again, it's not as cumbersome from a financial standpoint as one might think on day one. 5% of £150,000 property is only £7,500 on day one just to secure a unit. So it can be extremely affordable. But the first part of that journey is just trying to listen and understand, what position the client's in, and understanding if it can make sense for them.
So there are some relatively easy ways of actually getting into UK property from a client's perspective. It's not too difficult, not too expensive. He knows that he's got a year or two to put down the deposit, for example. Can you explain that a little bit more in detail? Sorry.
No, it's fine. I'll give you a good example with our Manchester project in the Victoria North that we've already covered. So it's just an example of one of the payment structures. So if you were to take, when we first launched them, the 2-bedroom units at £350,000, the first deposit is 10%. So you'd put down 10% now, so £35,000, and then that would secure the unit. Nothing else for another 12 months. So 12 months later, then you put another 10% down, so another £35,000. So let's call it December 2024. And then in July 2025, when it completes, that's when then you'll either pay the remainder in cash or you'll go and get lending. So from the client side, it's only 10% now to exchange, which is £35,000, 10% a year later, and then rest on completion. The Halifax project works slightly different. That deposit structure is 30%. So let's say on a £150,000 apartment, that's £45,000 deposit. But the way we've structured that is they'd only have to put 5% down now, so £7,500, and then they can pay the rest of that deposit off over the course of the build. So they can either do a monthly or quarterly payment for the other 25%. So by the time it's completed, they paid all the deposit and they're ready to get the lending or pay the rest in cash. We decided to, dependence on which direction they choose to go.
Okay, so only then their mortgage would then kick in once the property is actually ready to be handed over. And then
Correct.
from a tenant perspective, are you able to arrange tenants for our clients?
Yeah, absolutely. So we have our own lettings and management company run by a lovely lady called Pardeep. She's based in Manchester in Spinningfields. So she handles all of our clients' tenant arrangements. And the reason we want to keep that in-house is so that us as a business, you as a financial advisor, and you as your client and the tenant, we're all aligned, right? We all want to make sure that everyone gets a 5-star journey through that process. And ultimately, we want to make sure we get good quality tenants inside that property for your clients. And therefore, if we keep that in-house, we don't have to outsource. So yeah, so typically what would happen is if it's an off-plan building, a month to 2 months before, they'll start marketing the property. They'll get a list of tenants. They'll obviously vet them. They'll find out which one suits you as the client or the landlord. They'll figure out if that client's moving with or that tenant's moving with a furniture kind of pack already, or if they need a furniture pack put in there. And then they'll take care of the contracts. They'll take care of the moving in, and they'll take care of the ongoing management as well. So yeah, your client doesn't really need to get involved in it whatsoever.
That's super. All right. So have you seen over the past few years a larger uptake in acquiring property as part of their portfolio? Is that starting to pick up in the last couple of years?
Yeah, hugely. Yeah. I mean, like I said, my background has traditionally been financial planning, and I've run a number of financial advisory firms over the past 5 to 7 years. We started introducing physical property into some of the businesses I worked with about 7 years ago. And every single year you can see the uptick in companies like mine now into the market, the stock that's available, and the client's appetite. And I think that's been driven by a number of things. Firstly, it's a lot of time, it's been the first time clients have had the opportunity to talk to their financial advisors about physical property, because it's not always an asset class that IFAs get involved with. And so that's been super helpful. And secondly, let's be honest, you know, the last 5 years, if you weren't in the stock market, what were you investing in? Cash rates were doing pretty much zero or negative in some countries. Bonds weren't doing a lot. Gold's been fairly flat. So a lot of money was just going straight into stocks, right? And then all of a sudden you get a bit of a wobble in the stock market, and then people think, okay, I'm not as diversified as I should be, and then they start looking at these types of asset classes. So yeah, no, there's definitely been an uptick, and we see that increasing year on year now moving forward.
I think I've also seen it as well in the market in general. And, you know, if you look at the markets, there's always been a very easy to predict a bear market or a bull market. It's simple. Just get onto Google and you'll quickly find out, because everyone's leaning towards a particular thing. So it's quick to pick up the news. But somehow over the last year, I found that's not easy. And it's sort of instead of a 70-80% towards a leaning, whether it be bear or bull, it's now 50-50. It's like no one's really knowing exactly where the market's actually going. And I think maybe it might be just a thought that there's too many large events happening around the world and not just one that's affecting it in a positive or a negative direction. I think that just could be it. And that's why maybe the in the line of property and something that's asset backed is just helping the security of clients.
I agree. Look, in a world that, let's be honest, right now is completely unstable in many, many different parts, just having some degree of stability in your financial portfolio allows people to rest a little bit easier. I think the financial advisors love talking about property as well, because again, it makes their job a lot easier as well, right? You know, here's something that, like you said, it's asset backed, it's physical, it's going to do what it says on the tin. You don't need to stress about it. So actually having that part, I think it really helps the IFAs. But yeah, from a client perspective, just to know that, you know, you've got some money overseas. If you're in parts of Africa, you've got it in a more stable currency. It's in a country where you've got a better legal framework around that property. It's in a market where you've got a low supply versus a high demand. You've got rental increases, and you've got a market that, as I said at the start, returned 43 positive years out of 50. That is that comfort, security, and consistency that people do crave, I think. And look, to be honest, it's not. So it doesn't have to. It's not the most sexiest of product when it comes to returns, right? Like I said, I'd love to sit here sometimes and go, "We're going to make you 20% a year, never going to lose any money," or "We're going to do 40%, we did 50%." Like, we're never going to be having that conversations with people, but at the same time, we're never going to be going, "Okay, you've just lost 15% of your portfolio." It's that fairly consistency, certainty, comfort that people do want.
So it's really building a hedge in your portfolio. So what would your last piece of advice or last two pieces of advice to investors would be?
Speak to you, first of all, about seeing if this could form part of their overall portfolio. Advice piece number one. And then secondly, if you decide that you would like to go down the route of purchasing physical property, speak to a qualified professional, speak to a qualified company, speak to a company that understands how these things work, i.e. Global Residential or some of our competitors, it doesn't matter. But trying to do this on your own is generally not the way to go. So yeah, just speak to a professional, get some good advice, make sure the right questions have been asked, and go into it with 100% comfort that you have gone through the budgets correctly, and the decision to go down this route is one that's super thought out. Because like you say, it is a medium to a long-term play, and you've got to be comfortable when you go into an asset class like this.
There's a very interesting story, actually, I have to tell you. And that was my cousin from South Africa decided to go into the properties in the UK. And there's some wonderful scheme that they helped him purchase the property, and then they would tenant the property for him. And wonderful. It sounded perfect. They even gave him training sessions on how to build your portfolio. So that also cost him a little bit of pounds as well, in sterling, to do the necessary courses and etc. But 1.5 years down the road, on his first property, and he's battling to get out of it now, and there's no returns at whatsoever in it. And he's just got problems from beginning to end. And the agent that sold it to him is not on the horizon anyway. So as I said, it reminded me of a story of my cousin. I'm sure he's going to be happy that I now mention him. No, I didn't send his name in it, but those are the typical stories that can happen. I've also had a negative effect on a client with another property scheme as well. So I think that the whole issue is to be able to understand, just keep it simple, and get the professionals to do it that are more than qualified to do so. So I think your 2 points, I think you're about to say something, so I think let me allow you to say it, and then I'll finish off.
No, I think you're absolutely spot on. I think, look, same with financial planning, right? People think, oh, I don't need a financial planner, I'm going to do it myself. And then the amount of stories I've seen in the years of people try to do it themselves, they think they've got a good grasp on it, but reality of it is they don't. You can't train to be a financial planner in 2 weeks and just start running your own portfolio and understanding the tax elements, the investment side, and everything else that goes along with it. And it's the same with property. Go and get advice with a professional, get some support along the way, and ultimately it's gonna save you more money than doing it for yourself. That's for sure.
Absolutely. So having said that, thank you so much, Greg. I think we have explained it as best as we possibly can and in absolute depth. So I really appreciate your time. And I think on your 2 points, namely, get a professional, come speak to me, and I'm sure Greg will be available if you're wanting to speak to me, and we can chat to you together, and we can present to you something that is going to be fit and right for your particular portfolio, so that you can strategize correctly to get the right return in the long term, and to bring that safety net and that hedge into your actual portfolio. So that's it from us. Thank you so much, Greg, and look forward to chatting soon.
Thanks ever so much. Cheers, Brian. Thanks, everyone.